Investors often focus solely on the returns of mutual fund, overlooking the hidden metric of costs. While taxes are apparent, inflation and product costs silently erode returns. In India, mutual funds have a transparent cost structure thanks to SEBI. This video explores the impact of cost on returns, the benchmarking practices of mutual fund, and how SEBI regulates them. Welcome to holisticinvestment.in. First, costs in mutual fund. We will be discussing entry load, exit load, and expense ratio. Entry cost. Entry load is nil. Period to 2006, mutual fund asset management companies, that is AMCs, charged front-loading fees of about 2.25%, mainly for agent commission. A 6% charge called the new fund offer fee was applicable during a new mutual fund launch, covering initial expenses. SEBI removed both charges, making India the first country with zero sales charge mutual funds. Apart from a 0.005% stamp duty tax and standard bank or platform transaction charges, there are no hidden costs during mutual fund purchase. Next, exit cost. Exit loads are fees paid to mutual fund upon withdrawal. Not present in all funds, it varies based on categories of funds. Equity funds usually have a 1% exit load, encouraging longer term investment and discouraging frequent trading. Some funds may reduce exit loads with an increased holding period. Certain fund types do not impose exit loads. Fund type like overnight, liquid, ultra short term funds usually don't impose exit loads. However, some other debt funds might have a small exit load. Next, maintenance cost, expense ratio, a percentage deducted from asset under management to cover fund cost and generate profit. Components of expense ratio. In-house expenses covers AMC costs like office, staff, and fund management. External services include fees for registrar, transfer agent, custodian and benchmarking licenses, trustees, and lawyers. Brokers and distributors commission. It covers commission paid to selling brokers and distributors. Next, SEBI regulations and expense ratio computation. SEBI imposes limits on the expense ratio, defining the maximum charges mutual funds can apply to investors. The expense ratio is presented as a single percentage, example 1.5% or 0.45%, with the calculation method tied to the asset under management, AUM, for a specific scheme. You can refer the table here. Expense ratio for open-ended schemes. The practice of setting expense ratio based on AUM levels originated with the mutual fund regulation in 1996. To illustrate how expense ratios are determined based on AUM, consider two equity mutual fund scheme. Scheme A with rupees 2000 crore AUM, charge structure. 2.25% on the first 500 crores, 2% on the next 250 crores, 1.75% on the subsequent 1250 crores. Overall expense ratio is 1.91%. Scheme B with 60,000 crore AUM, charge structure 2.25% on the first 500 crores, gradual decrease until reaching 1.05% for the last 10,000 crores. Overall expense ratio is 1.29%. Here is the observation from these two funds. As the fund sizes increases, the average expense ratio tends to decrease. The expense ratio seen in the account statement is an average considering different charge slabs based on AUM. Some fund houses strategically maintain the size of certain schemes below rupees 1000 crore to capitalize on higher costs. Larger funds may have lower average expense ratio, while smaller funds might have higher averages. Next, expense ratios in debt funds. They are generally lower, reflecting the assumption of reduced management costs related to handling bond portfolio. Furthermore, considering the typically lower returns in debt products, expenses are initially kept 0.25 points below those of other funds. Debt funds often swiftly approach regulatory ceilings primarily because they are predominantly acquired by entities with substantial bargaining power, including institutions, corporate treasuries, and high net worth individuals. Next, SEBI's reduction of expenses explained. SEBI's concern. SEBI intervened as market dynamics weren't favoring investors, increasing profit margins and distributors' commissions without corresponding price reduction concerned SEBI. SEBI identified the following issues: varied charging practices, direct AMC commission, and close-ended scheme impacted the total expense ratio resulted in unhealthy environment with mis-selling and unnecessary portfolio changes. SEBI's action in 2090. SEBI implemented as 1.05% cap on the total expense ratio, aiming to address issues, protect investor interest, and curb practices favoring higher distributor commissions. What should be the investor consideration? Investors should understand the significance of expenses. Verify whether fund manager justify additional cost by achieving returns above the benchmark. For active funds, ensure returns exceed the benchmark to justify extra cost. Consider low-cost index funds if active funds fail to justify expenses. Make informed decisions aligned with financial objectives for optimal returns relative to cost. Next, measuring mutual fund performance. NAV, net asset value, is crucial metric indicating the value of portfolio per unit in mutual funds. It is calculated by dividing total portfolio value by the number of units outstanding. It influences buy-sell points, reflects real portfolio value, and aids in returns calculation. The NAV growth translates into portfolio growth. Undistributed profit, interest, and dividends contribute to the mutual fund portfolio growth. Under growth option, it gets compounded, and under income distribution come capital withdrawal option, that is IDCW option, it gets distributed. Daily mark to market adjust NAV for expense ratio deductions. Resultant NAV multiplied by units held gives total portfolio net worth. Investors should dispel the misconception that higher NAV means better fund performance. SEBI mandates cut-off time. SEBI mandates daily NAV disclosure by 11 p.m. for most schemes. Cut-off time determines NAV for buying or selling orders. Before 3 p.m. usually gets the same day NAV. Next, returns on mutual funds. Two key measures assess mutual fund performance. Number one, point-to-point return. It tracks a day-to-day fund performance. Example, NAV increase from rupees 10 to rupees 50 over 3 years implies 400% return. Next, compounded annual growth rate. It calculates the annual growth rate over a more extended period, offering a better understanding by considering the time taken for investment growth. Additionally, there are two types of return: trailing return and rolling return. Trailing return, it shows CAGR over predefined period but may hide true performance within a year. Next, rolling returns, it assesses performance over an extended period, offering a comprehensive view of a fund's performance including both good and bad phases. It provides a more informed evaluation of the investor experience. Next, benchmarks in mutual funds. Benchmarks are standard indices used to measure a fund's performance against the market or a specific sector. Mutual funds invest in a diversified portfolio of assets, and benchmarks help assess their returns and relative performance. In 2018, SEBI urged the use of total return indices (TRI) over price return indices for a more comprehensive measure. From January 1, 2022, SEBI specified benchmarks for each fund category, promoting uniformity. Tier 1 benchmarks such as Nifty 100 and S&P BSE 100 TRI offers clarity. Tier 2 benchmark address nuances in specific composition and risk profiles, providing a refined evaluation. Here are the simple steps to check regarding benchmark. First, focus on major benchmarks like Sensex and Nifty 50 for overall market performance. Step 2, check the benchmark for the specific category your fund belongs to, like large cap fund or mid cap. Next, consider the average return for all funds in that category to gauge performance. This helps to optimize investment decision. Conclusion: investor should be vigilant about hidden cost and fund performance. Utilize measures like NAV, CAGR, and benchmarks for accurate assessments. Seek advice from qualified financial planner to avoid false beliefs and make informed investment decisions. A detailed blog post on this topic is available in our website. The link is given in the description. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming enlightening investment webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.